Why do the majority of traders fail? Today I'm going to explain why the majority of traders fail, and I'm going to offer you a solution on how you can become a profitable and disciplined trader. The first thing we need to look at is traders versus the market being the S&P 500. And we know from data that the average trader earns between 3 to 4% annually, while the S&P 500 earns around 10% annually. This means that the more time that passes, the less likely you will beat the market, and new investors and traders confuse short-term profitability with long-term success, which means even if you are beating the market in the short term, that does not guarantee you will continue to in the long term. Since 1950, the S&P 500 has a 10% correction on average every 1 to 2 years and a 20% or greater decline bear market every 6 years. Correction recoveries take anywhere between 3 to 6 months on average, and a bear market recovery takes anywhere between 1 to 2 years on average. That means if you are in the market, you need to be prepared for corrections and bear markets, but you also need to understand that the market recovers from them, which is very important to remember. On average, the S&P 500 wins more than it loses. The S&P wins 54% of the time daily, 73% of the time annually, and 94% of the time every 10 years. This data is telling us that the S&P 500 is going up nearly 3 years out of every 4 years. And if you have a long-term horizon, the market is a very reliable way to make money. So it's important to understand, why is the S&P 500 winning? The S&P 500 is an index, which means that bad companies are removed from the S&P 500 and they were replaced with good companies to ensure that there is growth over time. On top of that, the index has a weighting factor, which means that larger and more successful companies carry the most weight in the index, and great examples of this would be Apple, Microsoft, and Google, along other blue chip names that you are very familiar with. It's also important to understand that as long as we have capitalism and a growing nation, with inflation and an increasing money supply, as well as the compounding gains of growth over time, there is a very good chance the statistics of the win rate of the S&P 500 and its growth will continue to an ever-growing S&P 500 index. So what can be learned from the S&P 500 if we want to become a better trader or investor? The number one rule with being a good loser is that you have to acknowledge when you are losing on a trade or a position and cut losers early. And the most important part of being a successful trader or investor is letting your winners run. When you have a position or a trade that is losing, do not be afraid to cut it loose. And when you have a position that is winning, let it run, because winners can gain thousands of percent that will more than offset the times that you're losing. A 50% loss requires a 100% gain just to break even. And it's very important to understand that losses are limited to a 100% loss. It is only possible for that to go to $0. However, your gains are uncapped, meaning that if you pick a good stock that is growing and you are in a good trade, you can make thousands of percent on that trade, which means that your winners will far outweigh your losers as long as you let those winners run and you actually realize those thousands of percent gains on when you have a very solid setup and a very solid trade or investment. So the lesson to be learned here is, do not let your losers destroy your winners. By far my favorite quote that I apply to trading is by Bruce Lee himself, and this is what he says: "Empty your mind, be formless, shapeless, like water. You put water into a cup, it becomes the cup. You put water into a bottle, it becomes the bottle. You put it in a teapot, it becomes the teapot. Now water can flow or it can crash. Be water, my friend." So keep this idea of moving like water in mind as we continue to go through these lessons, because moving like water is going to allow you to cut your losers before they become too large, and it's also going to allow you to move like water and let your winners run so that they can continue to make you the maximum amount of profit. I truly believe to be a great trader or investor, you need this mentality of moving like water, because it'll allow you to get over your pride, it will allow you to admit when you are wrong and cut that loss early, and it will allow you to celebrate your winners and allow them to continue to run by recognizing that you have a winning position and you just need to move like water and get out of your own way so that it can continue to flow and make you that money. It's important to understand the difference between discipline and motivation. All traders are motivated to make money. Motivation is what gets a trader or investor into this game in the first place. But what you're going to find is that the majority of traders lack the discipline to do it. So motivation by itself is not enough. Everybody is motivated to make money. Everybody wants to be a great trader. But as I showed you in the statistics, the majority of traders are not even beating the market, which is why learning to have discipline is far more important than simply just being motivated to make money or become a good trader. Motivation is going to do nothing for you in the long term. You need to learn to have discipline. So I look at it like there's three types of traders. Number one is your average trader. Number two is your bad trader. And number three is the rarest trader. Statistically speaking, there are very few of them, and these are your good traders. Allow me to introduce you to the average trader. He has a 51% win rate, and he feels very smart when he's winning. When his account is going higher, he is sitting at the top of a mountain screaming, "I'm a genius. I'm the best trader in the world." However, when he starts to lose, he gets very frustrated, and he's looking at his trading account going lower saying, "What is going on? There's something wrong with the market. There's no way that I could be losing money. I'm a genius after all. How is this happening? The market must be rigged." Next, we have the bad trader. The bad trader also has a 51% win rate, but the difference here is the bad trader lets their losers run, and the bad trader is taking profits often and early. The bad trader is usually very emotional and really struggles to understand that a position can lose and thinks maybe if I just continue to buy more, it'll eventually become a winner. Or I can't sell this position now, I don't have any profit yet. And then when the bad trader finally does have profit, they've gone through such an emotional roller coaster of watching that position be underwater that they take profit at barely break even or at very small profit margins. And then finally we have the unicorn, the good trader. The good trader still only has a 51% win rate, but the good trader is identifying their winners and letting them run. And the good trader is cutting losers early. As soon as a position starts to go against what was the expectation or beyond the risk level, the good trader cuts it loose and says goodbye and does not allow it to erode the profits away from the winners that are running. The good trader moves like water. Which brings us to our next quote by Bruce Lee: "Knowing is not enough. We must apply. Willing is not enough. We must do." Remember that all three traders all had the same win rate of only 51%. The difference is that the good trader was applying the knowledge of what it takes to be a profitable trader and then having the discipline to do that process and consistently follow a trading strategy that allowed them to be profitable and identified when they had to cut losers and let winners run. Whereas the bad trader was failing across the board, getting way too emotional about everything and not actually applying or doing any of the principles that allowed them to be profitable. And the average trader is somewhere in the middle. They know enough to be dangerous, but they're their own worst enemy because they have too much pride when they're winning and they're failing to recognize that they're just on a hot streak, and then they get a little too confident and get away from the discipline that allowed them to experience that profitability to begin with, which is why the good trader is going to be the rarest trader you're going to find. And I would argue that in a group of 100 traders, you are only going to have anywhere between 3 to 5 good traders. So this goes back to the point of discipline versus motivation, because all three types of traders we just talked about are all motivated to make money, but 2 of the 3 traders lack the discipline to do it. So this begs the question, how do we become disciplined? How do we become the good trader? Find your edge. Your edge is what sets you apart from every other investor and trader. To find your edge, you must recognize that emotions are your worst enemy in trading, and often your emotions will tell you the wrong thing to do. To get away from this, you have to develop a mechanical and emotionless trading strategy, and then you have to follow it over and over and over and over and over again. It's that simple. Can you do it? Yes, absolutely. Will you do it? You decide. Which brings us to our next Bruce Lee quote. "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." Once you find your edge and once you find what works for you, you need to get that discipline to practice it over and over and over again until it is just that one thing you need to have your edge over every other trader in this market. And then you will really start to become that good trader because you will know what works for you. And there are so many profitable trading strategies and investment strategies out there, but if you do not relate to them or you do not understand them, you are going to lack the discipline to follow them, and you are going to get emotional because you don't understand why you are trading or investing that way way to begin with because it is not your edge, it is somebody else's. So for that reason, you have to find out what you are good at. You will have to do some experimentation. And then once you start to narrow in on your edge, you need to do that over and over again, practice it, refine it, and continue to be disciplined enough to follow it. And then you will truly unlock your potential as a trader and profitability. And you will become that unicorn that is the good trader who knows how to let their winners run and cuts their losses. And you will have a process that you are disciplined enough to follow over and over again. And now and only now will you truly be moving like water. All right, let's say you got to that point and you tell me, look, I've tried everything. Trading is not for me. I am horrible at it. I can't be profitable or disciplined enough to follow a strategy. Well, I have good news for you too. If all else fails, simply buy low and sell high because the data suggests that it works. Buying the S&P 500 low works for long-term investors that have an outlook of 10 years or longer. But the important thing you need to remember is that some stocks go to zero. I will repeat, some stocks go to $0. Which means if you simply continue to buy crap and you're using the excuse that you're buying that crap because it's low, that is not the principle that I am teaching you. You must use the odds of the S&P 500 and you must actually be buying the S&P 500 during corrections and bear markets for this strategy to work. Now keep in mind, this strategy still requires patience and discipline. You still need to have the patience to wait until the S&P 500 is low. Then you need to have the discipline to buy while everybody is freaking out and fearful. And that is the very famous Warren Buffett saying that buy when everybody is fearful or buy when there is blood in the streets, because even the greatest of all time investors know that buying the S&P 500 while it is on discount is a long-term successful strategy that requires very little skill. It simply requires understanding the odds and statistics that we talked about today and understanding why the S&P 500 goes up over time, because it is an index that cuts the losers and allow the winners to run. So with all of that being said, I leave you with one final thought today. Be water, my friend.